Stories to tell and dig up the peculiar and wonderful treasures that reveal what a country is made of.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Good morning. I'm Jemana Bersachi in Dubai, and here is what we're following this morning. President Trump says there's been a lot of progress in talks with Ukraine on a deal to end Russia's invasion. He hosted Volodymyr Zelensky at his Mar-a-Lago resort in Florida on Sunday. There was agreement on security guarantees, but the future of the Donbass region is still a major sticking point.
We had a terrific meeting. We discussed a lot of things. As you know, I had an excellent phone call with President Putin that lasted for over 2 hours. We discussed a lot of points, and I do think we're getting a lot closer, maybe very close.
We discussed all the aspects of the peace framework, which includes, and we have great achievements, 20-point peace plan, 90% agreed, and U.S.-Ukraine security guarantees, 100% agreed. U.S.-Europe-Ukraine security guarantees, almost agreed. Military dimension, 100% agreed. Prosperity plan being finalized.
Taiwan's Air Force has launched fighter jets after authorities detected 4 Chinese Coast Guard vessels approaching its waters. Beijing had said it would hold military drills around the island from Monday. Local media say the exercises will disrupt air and sea traffic. Beijing says the drills are a stern warning against Taiwan independence after the U.S. announced a major weapons package for the island. SoftBank is said to be in advanced talks to acquire Digital Bridge Group, a private equity firm that invests in assets such as data centers. Bloomberg understands that a final agreement is yet to be reached, and details, including the timing, could still change. SoftBank is trying to capitalize on soaring demand for the computing capacity, which underpins artificial intelligence applications. Major storms on both U.S. coasts are disrupting travel during the busy post-holiday period. Airports in New York, Detroit, Philadelphia, and Boston have been hit with heavy snowfall, with more than 1,600 flights canceled across the country. In California, heavy rain, mudslides, and flooding have led to road closures, while the Great Lakes region is facing hazardous travel conditions due to accumulating ice. And a look at how markets are faring. We are now open. The Stock 600 is barely up, about 9 basis points as it has just opened for trade. S&P futures down 0.2%. Silver plunging this morning, down 4% after a record rally, breaking through $80 per ton earlier on in the session. And then Brent, we have trading more positive as well, up 1.1%. 61.30 is where we're at, on anticipation of further fiscal stimulus out of China next year, but still on track for its 5th monthly loss. That was your recap, and this is Bloomberg.
I think fixed income makes a great investment choice. But our job as fixed income asset managers is to engage in that risk mitigation. And if I were the Fed, I'd start thinking about going ahead and lowering rates. I don't necessarily think success is about sharp elbows. It's really about creating a great team, to be thoughtful with regard to leadership.
most sixth graders are simply trying to get through school, Ann Walsh, a self-proclaimed military brat, was already fluent in the language of business thanks to her father.
When I was in the sixth grade, my dad was also an investor, so we used to talk about business quite a bit around the dinner table, and I actually knew and understood bond math in the sixth grade, so I think it was predestined.
Walsh earned her accounting degree from Auburn University at the age of 19, and she soon found an opportunity to put her skills to use.
My first job out of college was at the Retirement Systems of Alabama. One of my first assignments was to monitor the private placement covenants. And it was one of those moments where I kind of went, I don't know what I'm doing, but this looks like I could benefit from having a law degree.
Walsh pursued an MBA at Auburn, then enrolled in law school at the University of Miami. She studied at night and worked full-time by day. Walsh took on roles in fixed income and insurance. In 2001, as CIO of Reinsurance Group of America, she crossed paths with the late Scott Minerd. At that time, she was a client of Guggenheim. A conversation with him eventually changed the course of her career.
One day I said to Scott, I'd like to switch gears. Would it be possible for me to come work with you and for you? He said, yes, Ann, but the Chief Investment Officer title's already taken.
In December of 2022, Minerd passed away, leaving the CIO seat vacant. Walsh eventually stepped into that role. Today, she serves as the Chief Investment Officer of Guggenheim Partners Investment Management, the global investment management division of Guggenheim Partners. Walsh now oversees nearly $350 billion in assets. Walsh says the firm's investing philosophy is centered on minimizing losses, not chasing returns, especially when it comes to managing risk.
We are caretakers of our clients' money. At the end of the day, whether it's an institution, a pension plan, insurance client, they have policyholders, there's an individual whose money we're protecting and taking care of.
So let's go right to the heart of what the investment world is thinking about these days. The President of the United States, as we've talked recently, has been interested in having lower interest rates. Based on the data that you've seen, do you think it's a good idea now for the Federal Reserve to lower interest rates?
Well, I think there's two elements here. The Fed doesn't want to lower rates and appear to be kowtowing, if you will, to President Trump's language. On the other hand, I think there's actually room for them to lower rates. If you look at the Fed's Beige Book, which the Fed reacted to last year when they started lowering rates, I think there's room for them to take action now. And if I were the Fed, I'd start thinking about going ahead and lowering rates. Real rates are very high right now relative to history, and of course we have a pretty significant term premium built into the term structure of interest rates right now.
So let's talk about the Fed's goal, which is 2%. Is that too low a rate to really get to at this point? And does it have to be at 2% or in sight of 2% before the Fed should lower?
They have a credibility issue right now. The Fed has to get to 2% because that was the target that they set. Although they've already started to project that they're willing now to target a range of inflation, which I think is the approach they should have taken all along. But they're going to get to 2%, and I think the trajectory is still in favor of the Fed's 2% target.
Are you worried that the annual deficit, which is now approaching $2 trillion a year, and the total indebtedness, which is over $36 trillion, might be too much to sustain this bill passing the Congress? Or do you think the debt is really not as big a problem as people make it out to be?
So I tend to be in the camp of when you incur debt, you end up having to pay it back. With the rise of modern monetary theory, which has become in vogue in the last several years, particularly in Washington, which is the belief that if you print money, if you have the reserve currency, you don't actually have to ever pay that debt back. And so mounting levels of debt and deficit spending are fine. I don't buy that. I think there's a point at which the U.S. government has to be able to sustain itself. Because the cost of interest is going up for the Treasury, all of this just continues to accumulate. I think it's very difficult for our friends in Washington to get to the point where they're going to be able to return to levels of spending from pre-COVID. But in order to actually get that trajectory to settle down in terms of the future levels of debt, They'd have to return to pre-COVID levels of spending. I don't see that kind of willpower in Washington, so I think spending will continue. I think that we're going to continue to see real significant issues amongst bond buyers, and I think that as a result, the term premium has definitely gone up because there's a sense of more risk in the U.S. as a result of all this spending. I'm of the camp, we need some fiscal hawks.
Are you worried about our reserve currency status, given the fact we have so much debt? And do you worry that in the end, we will not be able to be the only reserve currency if we continue borrowing at this rate?
My view on the reserve currency status is that there's not really an issue right now. I don't see another currency coming in to replace the dollar. 70% plus of all transactions are conducted in dollars. And I think that gives us a unique benefit for the U.S. government. And I think the government has to be thoughtful with regard to being responsible to U.S. Taxpayers, responsible to our position globally.
Guggenheim Investment Management manages equities and debt, but more debt than I think equities. Are you worried that private credit, which has grown very dramatically in recent decades or so, is something that should be regulated by the federal government?
What we've seen in the U.S. is a very significant shift in the capital markets over the last, we'll call it, decade plus. And that is a move from a more public market to more private. And you yourself would know certainly the movement towards private equity-owned companies. I don't think that's a bad trend. I've been personally involved, and Guggenheim has been, for decades in private credit. What it's done is expand. And I think private credit providers can be much more nimble and can be more responsive, particularly to these private equity-owned sponsors. But additionally, what we're seeing is a huge growth in the need for capital. And traditional providers of that capital, whether it's banks or the public markets, have been shrinking their participation with private capital stepping in. Now, the question about regulation. I know regulators, particularly bank regulators, had been concerned, and I think remain somewhat concerned with regard to how to address this because of the lack of transparency. Lack of transparency doesn't necessarily mean that those credit markets are bad. It just means that they're not necessarily quite so visible.
For the average investor who may not understand the fixed income world, if interest rates go up, that means that bond prices go down, because the theory is if interest rates go up, the previous bonds that were sold at a lower interest rate, therefore they're worth less. So today, though, for the average person who wants to invest in fixed income, should he or she say, well, interest rates may be coming down, bond prices might go up, I should wait a while, or should somebody say it doesn't make a difference whether you pick it now as the time to invest in fixed income or wait till later?
The fixed income markets are a very large and broad market. I think critically, you should be an active investor. And that means that avoid the passive vehicles in fixed income. Why do I say that? Well, that's because in fixed income, you have very little opportunity for upside, except as rates come down, relative to, say, equities, where you have this opportunity for prices to go up as well as go down. So what's the key aspect to fixed income management is risk mitigation. You want to avoid any kind of risk of loss, whether that's from rates or whether that's from default risk or downgrade risk. And so as a result, being an active investor is critical. That's the first part. The second part is that we do believe that rates will ultimately come down. We do believe that the Fed will ultimately continue its trajectory of lowering rates at the front end of the term structure for rates. So we think that's a positive. So as rates come down, prices will go up. And that will be across the board in all the different sectors, absent a recession, of course, which is not in our projection at this time.
Historically in this country, we have recessions roughly every 7 years or so. Do you foresee a recession coming in the next year or two or three, or are you not that worried about it?
We've had a bifurcated economy. So those with access to capital, those at the higher end of the income earning spectrum, they haven't suffered. And so overall, what we've seen is a non-recessionary environment and a resilience to the U.S. economy. We anticipate that we're slowing down in the U.S., that what we're seeing from the Beige Book and other indications are that the market, that, you know, where we would have seen the economy kind of on the boil in the past, that boil's coming off. And so as a result, things are slowing down. But we don't believe to recessionary levels at the aggregate. And so I think that's our expectation is we will slow down to below trend growth, but not fall into recession. Having said that, the tail risks are higher than they have been in the past, and there is a lot more volatility and uncertainty with that expectation. Our recessionary expectation is probably about 30–35% right now. Would it be possible for me to come work with you and for you? He said, yes, Ann, but the Chief Investment Officer title's already taken.
Bringing you up-to-the-minute aerospace news whenever and wherever it happens. I'm Guy Johnson at the Dubai Air Show, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
So for those who may not be that familiar with it, fixed income or private credit, it basically you're putting up money with the expectation you're going to get your money back and a rate of return during that interim period of time before you liquefy your investment, right?
Right.
Okay. So let's suppose I say I have no risk tolerance. I don't want to lose principal. I just get the lowest interest rate I can. I want to get my money back. I should buy a treasury bill. Is that the safest thing theoretically?
So you've just hit on something that's really important, and that is the fundamentals of the way Guggenheim thinks about fixed income and, frankly, investing in general. We are one of the few, if not the, home of behavioral finance. So Dr. Danny Kahneman, who's really the father of behavioral finance, and he wrote a book, Thinking Fast and Slow, really brought to light about how investors perceive risk. And so to your question, what does an investor do when that's the way they think about risk? Well, I think fixed income makes a great investment choice. But our job as fixed income asset managers is to engage in that risk mitigation. All the tactics that are necessary in order to ensure that we are minimizing risk for our investors.
Let's suppose I'm a risk mitigator. I don't want to take any risk. Right. I want to get my money back. I want to buy a treasury bill. What kind of return am I going to get on a treasury bill?
Well, right now, you're getting over 4%.
4%, okay.
So that's not bad for a very short-term, no-risk investment.
Well, let's suppose I say I have a great confidence in the U.S. government. I'm willing to buy a 30-year treasury bill. I'll get my principal back in 30 years. What kind of interest rate would I get for that?
Well, right now, you're getting 5%.
Let's suppose I say I want to buy a treasury bill, but Guggenheim, I assume, like most money managers, charges a fee. Why don't I just go down to the U.S. Treasury Department, and when they have an auction, I just show up and say, I want to buy a treasury bill. Why do I need an investment manager to get me a treasury bill?
Well, that's because we're not going to invest just in treasury bills. We're going to invest in all those other aspects of the fixed income market that add value for our investors.
Okay, let's talk about how you became an expert in this area. So where did you grow up?
My dad was Air Force, so I kind of grew up a lot of different places and a bit of a military brat. But I spent a lot of time in Washington, D.C. in the suburbs.
And when you were a little girl, did you say, I want to be a fixed income money manager? Well,
it's funny you should ask that question. When I was in the 6th grade, my dad was also an investor. He was an accountant by training. And so we used to talk about business quite a bit around the dinner table. And I actually knew and understood bond math in the 6th grade. So I think it was predestined.
Okay. So where did you go to college?
I went to Auburn. I was an accounting major.
Yeah. Okay. Then you got an MBA as well?
Yes.
After that, you went to get a law degree. Now, usually lawyers get a law degree, and then they say, I really want business. Then they go to get an MBA. It's rare that somebody says, I'm in business, I know business, I have an MBA, and then they want to be a lawyer. So how did you come to that pattern, which is unusual?
Purely by happenstance. So my first job out of college was at the Retirement Systems of Alabama. One of my first assignments was to, I'm going to put this in air quotes, monitor the private placement covenants. And so at that time, because there wasn't a computerized system, the idea of computers were to walk me into a room full of closing binders and a rolling library of these, open the big book on a desk and say, now here's the covenants, go monitor them. And it was one of those moments where I kind of went, I don't know what I'm doing, but this looks like I could benefit from having a law degree. And so ultimately that's what drove me to the decision to go to law school.
But you were working, you had a job, and then your family say, you're making a living now, you're going to give that up to go to law school, and who's going to support you when you're doing that?
I didn't give it up. I actually went and got my MBA and my law degree while I worked. So I did those at night.
So after you get your law degree, what did you do next?
So I went to, and remained still in investing. So I've been in the investments world 41 years with no breaks, so continual. And I went to work at what was that time called American Bankers Insurance Group, and I became their head of investments when I was 21, actually, and managed their portfolio.
And when were you recruited to come to Guggenheim?
So Scott Meinert, who was the chief investment officer, and I met in about 2001. I became a client through my predecessor employer, Reinsurance Group of America, and I was the chief investment officer there. And we had a reinsurance treaty with a client of Guggenheim's. And so Guggenheim was appointed the asset manager. That's how I met Scott. And I was able to be a client for about 5 years when one day I said to Scott, I'd like to switch gears. Would it be possible for me to come work with you and for you? And he said to me, I remember this, he said, yes, Ann, but the chief investment officer title's already taken. So, of course, that's been a long-standing joke between he and I at the time. And, but no, we worked together until his sad passing 2.5 years ago.
Guggenheim was started when?
So Guggenheim was originally, I think, the family home office, but in its current form was basically founded in 2000.
And so the asset management function is the biggest part of Guggenheim today?
Yes.
So Guggenheim today is a privately owned firm. It's not publicly traded. Does it have any plans to do anything different? Or as far as you know, it's basically going to stay as a privately owned company?
Absolutely.
Your client base, is it institutions or individuals or both?
Both. Both. We have retail mutual funds, we have high net worth separately managed accounts, we have institutional clients. We like to meet our clients where they are and being able to provide our strategies to them. We are caretakers of our clients' money. At the end of the day, there's an individual whose money we're protecting and taking care of.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I haven't interviewed that many chief investment officers of gigantic investment firms like yours who are women. Now, when you got into this business, were there very many women who were rising up to become chief investment officers of multi-hundred-billion-dollar investment organizations?
I can't say that there were. We were quite rare. In fact, up until very recently, when you looked at the number of portfolio managers that were women, only a few years ago was about 10%. Now at Guggenheim, we have about 30% of our workforce is female, and that actually is at the higher level. So we have a long way to go to get to the point where women will be able to advance into chief investment officer roles.
So if somebody is graduating from college today, male or female, and he or she says, I like the fixed income world, Is that a good career for somebody? Would you recommend to somebody they get into the fixed income or the private credit world as an investment manager? Or would you say go into something like private equity?
I think this is a very, very solid investment career or career for any young person. A couple of reasons. Very importantly, we are caretakers of our clients' money. At the end of the day, at the end of every investor, whether it's an institution, a pension plan, insurance client, they have policyholders, there's an individual whose money we're protecting and taking care of. We are caretaking their savings, whether they're saving money for retirement, whether they're saving money for their kids' college, whatever. And so that's very important. It's very purposeful. Our particular management style is one that's very team-based and collaborative. And in that way, it makes a wonderful career for young people, and particularly young women who want a collaborative workforce opportunity, and they also want a purposeful career.
Now, in the investment world today, there's been a push to get people to come back to the office, to actually be in the office physically. Do you require all of your employees to be in the office, or you can do it on a screen? It doesn't make much difference in your business.
So at the end of the day, this is a people business. Our mission is to serve our clients. The best way we can do that is to be together. It's also important because generationally, I mean, I've been in this business 41 years. I suppose I could work from home pretty easily. I know what I'm doing. But I wouldn't be transferring my knowledge to young people that way. It's not as convenient. It has to happen day in and day out as our younger people are observing the behavior of our more senior team members, and that interaction is very important, and it has to be done in person.
Now, in recent years, parents who want their children to get jobs in the investment world obsess over having their children be a STEM major. Suppose somebody applies for a job at your firm and says, look, I'm a philosophy major, I'm an English major, I'm a history major. Does that person have any chance of getting hired?
Oh, absolutely. I really look for characteristics relative to hiring to a resume. Critical thinking, intellectual curiosity, grit. This is an industry where you're going to work hard and you're going to work a lot of hours. And that's okay, but that's the person and that's the set of characteristics that I'm really much more interested in.
If I had $100,000 and I came to you and said, what should I do with it? What would you do with $100,000? You'd recommend it to somebody else?
Right now, because of all the volatility in the economy and in the world, I would say a diversified portfolio with $100,000 is the way to protect against risk and to provide the kind of return. So I would have a little bit of everything in there. Fixed income, again, with a knowledgeable manager. Equities, because I think the equity markets will continue to be solid, if not without some volatility, of course. I throw in maybe a little bit of Bitcoin, interestingly enough, maybe a small amount just for speculative holdings, and just create a very diversified portfolio against the risk.
So what would you say are the most valuable lessons you've learned as an executive on a Wall Street firm?
I think you have to be humble, because investing through cycles means that you're going to make some mistakes and you're going to learn some very important lessons. And to be thoughtful and not to have knee-jerk reactions to or overreact to too much volatility, news headlines, really separate the signal from the noise, and to be thoughtful, because these cycles will come and they will go. But to remain thoughtful and a long-term investor, those are the ways I like to think about risk and managing through all the different timelines that we are going to continue to invest in.
To succeed in Wall Street, most people would think on the outside you need to be tough, you need to kind of go after your competitors, you need to really be a difficult personality. What does it really take to succeed in Wall Street?
I don't necessarily think success is about sharp elbows. It's really about creating a great team, to be thoughtful with regard to leadership, to have a long-term view, to work really hard. This is a business where it's important to be dedicated, and I think that's the elements to success. All the other ones, which are table stakes, intellectual curiosity, critical thinking skills, understanding the markets, having great analytical skills, that's all table stakes. But it's how you do what you do that makes the difference. And I believe that, as much as anything else, is is creating a great team, and ultimately great results will come from that.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Good morning. I'm Joanna Bersacci in Dubai, and here's what we're following this morning. President Trump says there's been a lot of progress in talks with Ukraine on a deal to end Russia's invasion. He hosted Volodymyr Zelensky at his Mar-a-Lago resort in Florida on Sunday. There was agreement on security guarantees, but the future of the Donbass region is still a major sticking point.
We had a terrific meeting. We discussed a lot of things. As you know, I had an excellent phone call with President Putin that lasted for over 2 hours. We discussed a lot of points, and I do think we're getting a lot closer, maybe very close.
The U.S. president will meet the Israeli prime minister in Palm Beach, Florida, later today. Tensions between them have been rising, with Trump previously warning Israel not to undermine his peace efforts. They're expected to discuss the second phase of the Gaza peace plan, as well as Iran. And China has pledged to expand government spending and improve how it deploys capital in a bid to boost growth in 2026. The government will focus on better targeted fiscal policy, spending more on advanced manufacturing and tech innovation. It highlights the fine line Beijing is walking between buffering the economy against external headwinds and preventing a domestic debt crisis. And in markets today, we are open for trade for European indices, but trading slightly underwater. Same for the S&P futures. Silver pulling back from all-time record highs, down 4.4% today. And Brent also trading at around 61.3, up 1.1% on that talk of China fiscal easing. Also of note today, defense stocks taking a bit of a tumble. This has been a major outperformer for European markets for most of this year. Today, the likes of Leonardo and others down anything between 2 and 3%. Perhaps some profit taking into the end of the year. That was your recap. This is Bloomberg.
I think that AI probably for the next decade or two, if not longer, will be the most important technology. I think the biggest mistake is always emotion. Stocks are very easy to transact, and therefore, human emotion comes into play in a way that it doesn't in any other form of investing.
The GameStop short squeeze of 2021 is remembered by many investors as a wild phenomenon. But if you're D1 Capital Partners founder and chief investment officer Dan Sondheim, you would call it the worst 2 weeks of your career.
I was holed up in my office at home. It was like a patient in, it was quite intense.
D1 had taken a short position in GameStop, betting the stock price would fall. Everyone knows what happened next. Retail investors, people who don't invest professionally, bought the stock in droves, encouraging peers to do the same. the stock soared in value, and Sondheim's D1 was one of the professional shops that took a short-term beating.
I hadn't ever failed before in that kind of a way.
Before GameStop, Sondheim's investing career was a straight upward trajectory. After a few short years in investment banking, the Wharton graduate entered the hedge fund world at Viking Global Investors, where he would stay for 15 years.
I started out as an analyst covering banks, and over time I picked up every other sector and became co-CIO and then CIO.
And then in 2018, Sondheim struck out on his own with D1.
He was inspired by the phrase day one, which Jeff Bezos refers to a lot, and how he thinks about Amazon.
On day one, Sondheim opened the doors with $5 billion of raised capital. Today, D1 has $23 billion of assets under management. As for the GameStop saga, the years have provided Sondheim with some perspective.
Dealing with that kind of adversity and coming back from it is what I'm most proud of, because that was the most challenging part of my career.
Many people in the investor world are worried about the impact of tariffs and what it will do to the markets. Is that a concern you share, or do you think the tariffs are not as big a problem as some people are saying?
I think it really depends on how significant the tariff rates end up being. I think the market is implicitly assuming right now that tariff rates won't go through anywhere near the rates that are being talked about, that it's more of a negotiating stance than it is a real outcome. If they were to actually play out and the actual tariff rates were what Trump is suggesting currently, it'd be a very big problem.
What about inflation? That's been a big problem for the last couple of years after COVID. Are you worried about inflation anymore, or do you think that's largely under control?
Largely under control. I don't believe tariffs will be inflationary on an ongoing basis. This is a one-time step up in prices, probably offset by some demand destruction.
What about a recession? We haven't had a recession for quite some time. Historically, we have one every 7 years in the United States, and we haven't had one really for a while.
Yeah, we're always worried. I mean, I think that the chance of recession at any given time is dependent upon where you are in the cycle, what's happening from a fiscal perspective, what's happening with monetary policy.
So if you're going to look at a stock to buy, a company to buy, you tend to look at it for a month or two or three before you complete your research?
It usually takes us, if we've never looked at the company before, most companies we do have looked at in the past, but if it's a new company, it'll probably take us 3 to 4 weeks.
And when you're doing that type of thing, do you actually talk to the CEO sometime, or how do you deal with not getting inside information?
Yeah, we try to talk to the CEOs of every company we invest in, and we have compliance, our general counsel, and most public companies are already pretty aware of what they can say and what they can't say, so it's not a big issue.
So you are one of the few, but not the only large firm of your type that not only buys stocks of this type, but also shorts them. Mm-hmm. Shorting is a more complicated business in many ways, unless you're really hedged. Why are you comfortable doing shorts?
I started out in the business. I got my first job because I wrote up a short report. I like shorting stocks. I find it intellectually challenging. And from a business perspective, there are a lot of people who are talented at buying stocks. There are fewer people who are talented at shorting stocks, or perhaps fewer people who have the desire to short stocks because it is more difficult and more stressful and less profitable over time.
So you were involved in a very famous short that didn't work out quite so well, called GameStop. Is that right?
Correct.
It seemed as if somebody was manipulating something or another so that a company that maybe should have been shorted all of a sudden became a heroic gainer. How do you deal with something like that?
Painful. That was the toughest. That was the toughest few weeks of my career, and I'm hoping that that period of time will be the toughest going forward. Unfortunately, we had never seen shorts go up 300, 400% in 2 weeks. It wasn't in, even a 5 standard deviation move based on history. No one had ever seen that. So from a risk management perspective, we just weren't prepared for that. And we ended up taking off the positions at the worst possible time, knowing it was the worst possible time. But if it had gone on for another couple of weeks, it was that painful and that damaging that we had to do it.
So in the hedge fund world, when you take a position, let's suppose you take a long or short position, and it moves against you almost in the beginning, do you say, I made a mistake, I'm getting out of here? You say, I know more than the market knows, I'll wait a month, I'll wait 2 months, I'll wait a year. How long do you wait before you say the market knows more than you know?
It really just comes down to the research. You know, if sometimes stocks move and they move for a reason which is driven by fundamental changes in the business, in which case we have to reevaluate our thesis and perhaps, you know, change our position. If the stock is, but oftentimes stocks move irrespective of what's happening in the business or the fundamentals. And in that case, that's more of an opportunity to double down on an investment.
And today, when you are making investment decisions, is it a team effort? You have a consensus in your organization? Suppose somebody says, I just disagree with this, and the other people don't agree with that person. Can one person hold up something other than you, or you're the only person who can hold up an investment from being made?
I mean, we don't necessarily have like layers of people approving or not approving of investments. We have a collaborative culture where we all sit down and talk about it. And it's okay if some people are, usually it's not about hard disagree or, you know, hard agree. Usually it's gradations of this is an amazing investment or it's okay. And ultimately it's my job to listen to all the different opinions and come out with a conclusion.
So in the business you're in, when you say an investment is okay or good, you were looking to get a rate of return, let's say annualized of 20% a year when you're all said and done, or higher than 20% a year, or 15% a year? What are you looking for when you say, I'm going to go ahead with this investment?
It depends on the risk profile of the company, but in a large cap, high quality company, 20% over 3 years projected IRR would be sufficient. If you're taking more risk because the company's products are earlier or has more leverage, you're going to be demanding IRRs that are closer to 30%.
So you've been a big investor, as I understand it, in SpaceX.
Yeah. So
SpaceX is a private company. Many times hedge fund people buy publicly traded stocks or they short them. They don't do privates as much because it's a different game, really. But you do publics and privates, and SpaceX is a company you're invested in, right?
Correct.
And it turns out to be a pretty successful company based on private market valuations, I guess.
Yeah.
Were you in there early?
We first invested probably 6 years ago.
So the valuation now is probably, I don't know, a couple $100 billion.
350, yeah.
350 billion is the last round they raised. Okay, and it was up, before that was like 175 or something like that. So you were in well below that. So
yeah,
pretty good
approximately
position.
30 or $40 billion are probably where our entry point on a weighted average basis.
So in something like that, do you get concerned when the person who is the CEO of it or the founder of it is in the government and not running the company? Or I know they have a very good number too, but is that a worry or not so big deal?
It wasn't a concern for me. Look, I think that Elon's obviously, you know, a generational talent, and I wish he spent all his time at SpaceX. But he also has built up an amazing team that is quite capable of running a business day to day. And where he, I think, really where he excels is stepping in and solving problems, not necessarily being there day to day to manage everything.
So I think you've been a big proponent of artificial intelligence as something that's really going to change the world. Do you invest in small companies that are in artificial intelligence, or you go to the well-known names in artificial intelligence? What's the best way to invest in artificial intelligence and make money?
The best way it's hard to say the best way. I would say the way that is most aligned with our business model is we've invested in OpenAI and Anthropic, which are two of the leading large language models. But I do think over time, there will be investment opportunities in many, many more companies driven by AI.
But you don't go look for the next young Anthropic or something like that. That's not your game, which is venture capital.
We don't go really early stage and try to compete with venture capital firms to invest in companies in the first year or two of their life cycle. We tend to invest when they get more mature.
Are there things beyond the internet and artificial intelligence do you think are the next technological waves that are going to merit your investing in them? So quantum computing or something like that?
Yeah, I think that AI probably for the next decade or two, if not longer, will be the most important technology. But just like the internet, you'll see other things that evolve because of AI, like robotics, biotech innovation. I think you'll see a lot of things driven by AI that are technological revolutions in and of themselves. Look, we never rest on reputation. I like to go out and meet clients, tell the story. Once clients get to know us, and the better they know us, the better the relationship is.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
In case you missed it, on the pulse.
Distinguish between companies are here because they're running international operations, the companies that are indigenous and working with the citizens of the UK, and make sure you get the regulation strategies right. With the rule of law and the great city of London and the great country that UK is, there's a plenty of upside.
What did you tell the Prime Minister?
I tell them to make sure the regulation's fair, be the best place for a non-UK based company to operate, and you'll get companies coming here.
Don't miss the pulse, live every weekday.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Let's talk about how you started this firm and how it's grown to be quite successful. So let's go with your background. Where were you born?
I was born outside of Philadelphia.
Okay, and what did your parents do? Were they in the investment world?
My father's a doctor. He's an internist. My mom is an occupational therapist by training. But my dad spent most of his time outside work investing. So I grew up around stocks.
And you always knew you wanted to be in business, so that's why you went to Wharton, I assume?
Correct.
And how did you find Wharton? The people were smarter than you thought or not as smart as you thought?
I was intimidated when I went because I came from a public school where I think we had 450 people who graduated and 2 went to Ivy League schools, including me. So, my going-in assumption would be that everybody there would be better prepared and smarter than me. I think that, at the end of the day, the people were impressive. But I felt that the education I got was sufficient. And, when I left, I didn't feel like, I was in a worse position than anyone else.
Some people that go to Wharton get a joint degree. They get an undergrad degree and they get an MBA almost at the same time. You got an undergraduate degree and then you went into the business world?
I went right into the business world.
And where did you go?
I went to Bear Stearns. I started out in investment banking, and then about 2 months into it, I moved into a group that did private equity within Bear Stearns.
Hey, and you did that for how many years?
3 years.
And then you left for a firm called Viking?
Correct.
Now, Viking was a so-called Tiger Cub, and it was a firm that was set up by Julian Robertson, one of his proteges, and you were there for how long?
15 years.
15 years. It's a long time to be at a
long time in a hedge fund, yeah.
Okay, and you rose up from the very bottom to the chief investment officer?
I started out as an analyst covering banks, and over time I picked up every other sector and became co-CIO and then CIO.
Hey, when you're the CIO of a firm like that, you're responsible for everything. So did you do stocks, bonds, macro, or were you mostly a stock person?
We Viking and D1 are primarily focused on fundamental research and equities.
So where did you get the name D1 Capital Partners?
It was inspired by the phrase day one, which Jeff Bezos refers to a lot, and how he thinks about Amazon. And, the idea is the first day when you start a business, there's entrepreneurial energy and, a sense of, motivation and, open-ended growth opportunities. And the idea that I never wanted the firm to become slow and bureaucratic, and so every day should feel like day one.
And the firm is now, how old? What year did you start the firm?
Started in 2018, so it'll be 7 years this summer.
All right, so 2018, and did you say to people, I'm starting the firm, I've been the chief investment officer of Viking, and give me all the money you can, or was it easy to raise money or hard to raise money?
At that moment in time, it was a relatively easy time to raise money, and I've been doing it a long time, and Viking had an excellent reputation, and so raising capital was not the most difficult part at that moment in time.
So how much did you start with?
Approximately $5 billion.
$5 billion, and today you're managing AUM of?
About $23 billion.
$23 billion, and today the firm is headquartered in Miami?
We kind of joint headquarters in Miami and New York.
Okay. And today you still specialize in what you've always specialized in, which is stocks more than, let's say, macro kinds of things. Is that right?
Stocks, well, I would say fundamental research of companies expressed both in public equities and private equity.
So how many investment professionals do you have now?
Approximately 30.
And so you make all the final decisions. You're the chief investment officer. So do you say to anybody, you can invest up to a certain amount yourself, or everything goes through you?
D1 is a partnership, and the partners at D1 have the ability to make investments on their own in certain sizes, but probably 95% of the investment decisions are made by me.
And do you have to go out and make the sales presentation yourself, or that your reputation is good enough you don't have to do that?
No, we have, look, we never rest on reputation. I like to go out and meet clients, tell the story, and I think once clients get to know us, and the better they know us, the better the relationship is, and the stickier it is over the long term. I hadn't ever failed before in that kind of a way, and so learning from that, getting better, and coming back from that is what I'm most proud of, and probably was the most difficult thing I've had to do.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily. Every business day at 2 p.m. Eastern, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
So young students often say, I want to get a job at a place like D1 Capital Partners or a place like that. I need to major in a STEM subject in order to get there, because if I'm not majoring in science, technology, engineering, math, I'm never going to get hired, so I can't major in English or history. Do you only take people who majored in STEM subjects, or do you take people who major in other things, or does it make a difference?
Doesn't make a difference. I would tell you that increasingly I have found that there are tons of people who are very good analytically, people who are good communicators, especially written. It's harder to find. So I would say that we are indifferent to what people major in, but we do care that somebody is both analytical and quantitatively competent, but also is a good communicator, because in our business, you have to make the case for an investment, whether it's verbally or written, and if you can't do that, you're going to have a hard time.
So in your long history as an investor, what's the best investment advice you ever received?
I think the best investment advice probably came from indirectly from Warren Buffett. And, it was when he talked about his evolution as an investor where he started out buying cigar butts at 50 cents on the dollar, and then eventually coming to the realization that the best way to create value is to buy great businesses at fair prices and then let them do the work for you by compounding value. That was probably the best advice, because when you start out investing, you start out with a very quantitative approach, and you're looking for things that are just like trading well below fair value. I think the idea of identifying, and then buying great businesses that may be trading at closer to what people perceive as a fair value, but over time will compound value, was a change in mindset that was important.
So what do you think the most common mistake that investors make is? That's the average investor, not a famous hedge fund person. What's the average person's biggest mistake, would you say?
I think the biggest mistake is always emotion. When you own a home, if your home goes down in price, you don't wake up that morning and get scared and fire sale it. You don't do that with any asset you own. But stocks are very easy to transact, and therefore human emotion comes into play in a way that it doesn't in any other form of investing. So I think people make mistakes both in terms of greed and fear, and it's mostly driven by different emotions.
So for somebody who's a young investor who's starting out in his or her career, just as you were 20 years ago, what advice would you give them about how they might start their own firm or their own career?
I think starting your own firm in this business is very difficult and usually a mistake, because you only get one shot to start your own firm, and if you fail, it's hard to do it again. So I would suggest start out by reading as much as you possibly can of whatever, if you're interested in fundamental investing, as I said, I think Buffett's fantastic. If you're interested in other forms of investing, I think reading is the best thing to do. And then go to the best firm you can and learn working for people that have done this for a long time. This is the kind of job that you're always learning. I learn every day, and so for anyone to think that they can start their own firm without any experience, I think is the wrong risk reward.
When GameStop was going on, did you find your friends looking at you differently, or do they call you all the time and say, how are you doing, or is it a different kind of way you were treated or not?
I mean, it happened in a period of 2 or 3 weeks, and no one was looking at me because I was holed up in my office at home. I was getting calls, more kind of people trying to inquire what's going on, how bad is it, but generally people kind of kept the distance because it was, it was like a patient in, it was quite intense, and that period of time though was about 2 weeks. And then we closed out the positions, and that was also very, very painful. We had to deal with it afterwards. But then we had another setback in 2022, and I kind of think of both of those as being, a period of time where, there were just a lot of challenges for our business in particular, and we had to make a lot of changes. So coming back from that was difficult. It required us being very introspective about what we did wrong, what we had to do to fix it, and then, pushing ahead and putting one foot in front of the other.
So one final question. So as you look back on your career, very impressive career, what are you most proud of having achieved so far? And if you could live your 25 years, let's say, go over again, what would you do differently?
Yeah, I think, look, I am most proud of, for a long part of my career, there was very low adversity. I joined Viking, and it was, we had 15 years of just, obviously there are periods of time when things weren't as good, but there was no real adversity. After starting D1, about 3 or 4 years after starting D1, we had several periods of pretty intense adversity in the investment part of the business. And you brought up GameStop as being, one event, then 2022. And for me, dealing with that kind of adversity and coming back from it is what I'm most proud of because that was the most challenging part of my career. I hadn't ever failed before in that kind of a way. And so learning from that, getting better, and coming back from that is what I'm most proud of and probably was the most difficult thing I've had to do.
Day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. I'm Joanna Versace in Dubai. Here's what we're following this morning. President Trump says there's been a lot of progress in talks with Ukraine on a deal to end Russia's invasion. He hosted Volodymyr Zelensky at his Mar-a-Lago resort in Florida on Sunday. There was agreement on security guarantees, but the future of the Donbass region is still a major sticking point.
We had a terrific meeting. We discussed a lot of things. As you know, I had an excellent phone call with President Putin that lasted for over 2 hours. We discussed a lot of points, and I do think we're getting a lot closer, maybe very close.
We discussed all the aspects of the peace framework, which includes, and we have great achievements, 20-point peace plan, 90% agreed, and U.S.-Ukraine security guarantees, 100% agreed. U.S.-Europe-Ukraine security guarantees, almost agreed. Military dimension, 100% agreed. Prosperity plan being finalized.
Taiwan's Air Force has launched fighter jets after 4 Chinese Coast Guard vessels were detected approaching its waters. The Chinese military is conducting exercises around the island, which Taiwan has described as irrational and provocative. Beijing says it's a stern warning against Taiwan independence and is necessary to protect China's sovereignty. Copper has barreled towards a record $13,000 a ton on the London Metal Exchange in a stunning end-of-year rally. The metal surged more than 6% when trading resumed after a 2-day public holiday in the UK. Copper made big gains in December as investors bet that a rush to get imports to the U.S. ahead of possible tariffs would force buyers to elsewhere to pay more. Major storms on both U.S. coasts are disrupting travel during the busy post-holiday period. Airports in New York, Detroit, Philadelphia, and Boston have been hit with heavy snowfall, with more than 1,600 flights canceled across the country. In California, heavy rain, mudslides, and flooding have led to road closures, while the Great Lakes region is facing hazardous travel conditions due to accumulating ice. And a check on markets. We are open for trade in Europe, dipping a little bit. The Stoxx 600 down 0.1%, S&P futures down 0.3, but still coming off very close to all-time record highs for the S&P. Silver plunging today, down 5.6%, pulling back from record highs there too, and a massive run-up into today. And Brent 61.50 is where we're at, 1.6% firmer on the session. Let's take a deeper dive into defense stocks as well, because what was one of the outperforming sectors in Europe today is seeing a bit of profit taking going through. Leonardo down almost 4%. Other names in the space as well down anything from 2 to 3% as well. That is your recap. This is Bloomberg.
I think all investing is value investing, and if it isn't, it's either gambling or speculating. An investor should recognize that the biggest threat to their generating a return over time is their own behavior. I have the patience to be out of favor for a decade, but I love the idea that my thoughts and ideas are right, and I have the patience to let them unfold.
In a classic American story, Chris Davis followed his father and grandfather before him into the family business. It just so happens that family business is a $20 billion investment firm, Davis Advisors.
Both my grandfather and father loved what they did, so that has a huge influence on a kid.
Chris's grandfather, Shelby Davis, began investing in insurance stocks in the 1940s. He turned an initial investment of $100,000 into more than $800 million by the time he left the business in the 1990s.
He talked to people about this concept of owner earnings, that, don't just look at the reported earnings, look through at what the business, if you owned the whole business, the value creation.
As the third generation Davis to run the firm, Chris still uses his grandfather's value investment approach.
That's sort of the core of what we do, making an assessment about what the value of the business is, generated by the earnings of the business, rather than by a prediction about changing psychology or being lucky.
Chris is militant about his discipline of investing, in which a company's fundamentals are paramount.
In a sense, we always say we're value investors because the valuation discipline is so central to us, but we want to own businesses that we can own for a decade or longer.
In addition to his father and grandfather, Chris had another value investor as a mentor, the late Charlie Munger.
Outside of my family, Charlie mattered more to me than any mentor that I could think of. He had made a huge difference, both as somebody that taught me a lot about investing and business, but also taught me a lot about life and wisdom.
Even has a bust of Munger in his office.
Charlie Munger once said deferring gratification gives him so much gratification that he's not sure he's actually deferring it.
And that patience is still a hallmark of Chris's investing style.
I don't mind that patience to let the value of the business appear over time. I don't need it all at once. I don't need the big payoff.
Tell me what a value investor really is.
Well, I think value investing is a redundancy. I think all investing is value investing, and if it isn't, it's either gambling or speculating. And if it's gambling, that means you're putting up money for something that has a negative return expectation, but you feel lucky. All the rest does is about investing. You're putting up money with the expectation of getting more in the future, and that expectation is based on an assessment of the cash flows and the probability of that assessment being validated. So that's sort of the core of what we do, is in a sense, making an assessment about what the value of the business is, generated by the earnings of the business, rather than by a prediction about changing psychology or being lucky.
But most investors would not describe themselves probably as value investors, so you're saying most investors are really buying some future anticipated earnings that they hope will be there but may not be there today.
Yeah, or often people make a distinction between growth investors and value investors. And I would say that to us is a strange distinction, because a company that grows profitably is more valuable than one that doesn't grow. So growth is a component of value. What I would distinguish from is momentum investing, and maybe that's been a big characteristic of the market in the last 10 years. The idea that because something is going up, it's likely to continue going up, so I'm buying it without regard to the underlying value of the business, but with an idea that somehow this pattern will continue.
So today we have the Magnificent Seven, so-called. Do you regard stock purchases of those stocks as value investing or momentum investing?
Well, a little bit like when FANG was popular or BRICS, and, you know, people come up with an acronym. They think the Magnificent Seven. But each one of those businesses has totally different business models, different prospects. They just happen to all be in favor at the moment. And I think the way to think about it is that when you get the valuations getting higher and higher and higher, you think about what would have to happen for you to earn a 10% return if you bought the whole business. And when you start breaking each one of those businesses down, what you find is there's some of them where they would have to grow, 20% a year for a decade. They'd have to maintain margins above 50%. And when you look at how many companies have done that in history, I think it's 0.1% of companies in the S&P 500 have kept margins above 50% for more than a decade.
But if what you say is true, most people who are buying stocks are not really value investors, right?
Well, I think that there's a whole category of people that get excited because stocks have already gone up, and then they want to jump in. So in a sense, they're what I would call momentum investors, but they aren't really value investors. Stocks have this peculiarity that they're the only asset where somehow the more the price goes up, the more people want to buy them.
So if a stock is, let's say, like NVIDIA, very highly valued stock company, or even Apple, which used to be very highly valued, still valuable, but not quite at the same multiple it once was, you would say those are not value investments, though Warren Buffett did buy Apple.
Yeah. What I would say is that in order for NVIDIA to be worth what it is, you have to extrapolate the durability of their competitive advantage way into the future. And if you think about the early days of the internet, we all knew who the winners were, right? It was Cisco, it was AOL, it was Yahoo. Those were the three titans of the internet. And in the early days of a transformative technology, people are very anxious to identify the winners. But remember, Google wasn't public yet. Amazon had, gone up to 80 and collapsed down to about 6. Meta, then Facebook, I don't think had come public yet. So there was a huge amount of speculation about who the winners of the internet were going to be before it was ready. Now, there's speculation today that NVIDIA has won the AI game, that the future of AI will be driven by NVIDIA in the same way the PC was driven by Intel, let's say. It's possible that that could happen, but it needs to happen to justify the current valuation. You need growth for a decade to come. You need to sustain high margins. And in a company like NVIDIA, where we admire them very much, and obviously I have some sour grapes because I missed it, but I think that I think you have a lot of their customers who are going into their business trying to design their own chips. You have a fabricator, TSMC, Taiwan Semi, that in a sense the only company on earth that can make their chips. So Porter's Forces would say that there's a lot of pressure on that going forward.
Your view on the economy now with tariffs as something that the president wants to impose, as inflation is still not completely under control, are you worried about a recession in the near term?
Well, I'm certain we're going to have a recession. I'm just not sure when. And that's a big part of our mindset is if we're buying a business that we're going to own for a decade, we know we're going to own it through some sort of shock in the system. What we sort of say is we can't predict, we can prepare. We have to be prepared, both for the sunny days where we'll make a lot of progress, but also to withstand the storms. And trying to predict the timing of those and reposition your portfolio, we think is a dangerous game.
So you're on the board of Berkshire Hathaway. Do you give any tips to Warren Buffett about value investing, or you mostly learn from him?
What's so amazing about Warren, and really Warren and Charlie, is in addition to being, maybe the greatest practitioners of all time of this art of value investing, they also both were dedicated teachers and talented teachers.
Now, in your office, you have a bust of Charlie Munger, so you must obviously admire him. Did you have a special relationship with him?
Yeah, I mean, you know, outside of my family, Charlie mattered more to me than any mentor that I could think of. He was, I met him when I was young enough. He had made a huge difference, both as somebody that taught me a lot about investing and business, but also taught me a lot about life and wisdom.
Warren Buffett used to say, I'd like to buy something for 50 cents that is really worth $1. And Charlie Munger said, well, if you buy something for 50 cents, you want to make sure that it's going to be a company that could be worth many, many dollars in the future. So you should buy at a discount things that are really going to improve and get much more valuable, as opposed to just buying something cheap. It might stay cheap. Is that in essence what they talk about?
Well, it's something that really connects to sort of the way we invest here, which is this idea that, you know, you want to buy something that is an attractive value, but if that underlying business has durability, high quality, resilient growth, it's so much more valuable because of just the nature of compounding over time. So if you think of buying that dollar for 50 cents, well, imagine if that dollar is growing 15% a year, then it may be worth paying 75 cents for that dollar because it has the ability to grow. So in a sense, we always say we're value investors because the valuation discipline is so central to us, but we want to own businesses that we can own for a decade or longer, in which case you want them to have these qualities of durable, resilient growth.
Take us inside and tell us what you can, without violating confidences, what it's like to be in a board meeting of Berkshire Hathaway. You've got, for a long time, you had Charlie Munger, you have Warren Buffett still there as the chair, and you've got other people now on the board. Do people ever say, Warren, you're wrong on this? Or Charlie, you don't really know what you're talking about? Does that ever happen?
Well, what I'd say is that, you know, I probably attended Berkshire Hathaway annual meetings since 1989, let's say. And I read every annual report and 10K. And the difference on the inside versus the outside is really very limited. In other words, this is a company that's valued transparency, candor. I mentioned Warren and Charlie, their ability to teach. And so I would say there were no surprises being on the inside versus the outside because of that culture. I would say the one difference of nuance is it's just amazing how much Warren and before Warren and Charlie together think about the durability of the business, how much they think about risk, how much they are determined that they are trying to build something to last, and the sense of responsibility they feel to their shareholders, the people that have their life savings in it. And that was one of the big lessons from Charlie in terms of our business, was to really reinforce this culture of stewardship. Both my grandfather and father loved what they did, so that has a huge influence on a kid.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Didn't really think I had a problem.
I would isolate, self-medicate.
Like 48.5 million Americans, they didn't choose addiction. Go to shatterproof.org/findstreatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/findtreatment.
Let's talk about how you became a value investor. Your grandfather was a very famous investor. His name was?
It was Shelby Davis.
Shelby Davis. And he started with nothing and worked his way up. How did that happen?
Well, he had originally wanted to be in public policy and to be a diplomat, and he had a PhD in international relations that he earned in 1929, and he worked for Hoover and worked for Governor Dewey when he was running against Truman. Well, when Dewey lost, he made my grandfather the deputy superintendent of insurance for the state of New York. So you can imagine what a come down that must have been. But you know, he went up to Albany, and what he realized is, of course, the soldiers were coming home, the baby boom was underway, the suburbs were being built, and life insurance was the first thing you bought when you got married and you created a family. So life insurance was like biotech. I mean, it was this hot growth sector. And my grandfather, as a regulator, looked at it and said, oh, no, these are gold mines. So he resigned at the end of his term, and he borrowed $100,000 from his wife's family, and he started investing exclusively in financial stocks in general, insurance in particular.
So was he investing his own money? Took that $100,000, invested himself, made $800 million for himself and his family, but did he take outside investors at some point?
No, and that was really where my father came into it. So my father got into the business in 1958, and he decided that he should build an investment counseling operation, in a sense, using my grandfather's discipline and approach, but to take in outside money. And that was when we started the client business in really 1966.
66, called Davis Advisors.
Yeah.
And now you manage $20-some billion?
20-some billion, and we started the mutual funds in 68, and with separate accounts and so on. And my father, while my grandfather stayed exclusively focused on financial stocks, my father took that same mindset and then applied it more broadly.
If I put $10,000 into your firm at the very beginning, 1966, what would I have today?
Well, today you'd have about $4.3 million. Now, if you'd put
that would be a rate of return of what?
Well, if you put the same amount in the S&P 500, it would be about 2.8.
Okay.
So that difference is only about 100 basis points. But the power of compounding over time, it's just amazing that the difference that makes. So if the market's returned, 8 or 9, and we've returned 10, that difference is compounded over time, is life-changing.
All right, did you grow up in a family where your father and your grandfather said you have to be a professional investor, you couldn't do anything else?
No, sort of the opposite, I think. Both my grandfather and father loved what they did, so that has a huge influence on a kid. If your dad is happy getting off the train at night, I would go meet the train out in Tuxedo, and all the commuters are getting off, and, they're looking gray and worn with their briefcases, and my dad would sort of spring off the train, and he loved what he did. So we grew up, when I'd go away to school, if my dad drove me, we would often visit companies on the way. So we grew up knowing, one, that they loved what they did, two, that it was interesting because stocks weren't pieces of paper wiggling around, in the news charts and so on. They were ownership interests in businesses. So we would visit businesses and their people, and it was just always sort of an interesting world.
After you got your master's, did you come and join the family business then?
Definitely not. There is always a risk that a family business becomes employer of last resort for people with the same last name. Right. And so there was sort of a strong understanding that there was no seat waiting in a family business. You had to go out and find your own way. Now, interestingly, when I first got out of a university, I went to seminary, and I had thoughts of becoming an Episcopal priest. So I actually moved to Paris and worked for the American Cathedral.
So when did you full-time come to work in this firm?
Well, around 1990 or so, 89, 90.
And you became the chairman when?
And I became the chairman in 1998.
Okay, so now are you spending time running the firm, investing, looking for clients? What are your responsibilities?
Well, if I had a business card, it would say analyst on it. That's still my full-time job. It's the part of the job I love. I love visiting companies. I love, this idea of business people price. It's a constant puzzle. Every day it's interesting. So I still spend a lot of time visiting companies. I love that part of the job. I like going out and traveling. So I'd say that's the lion's share.
So your grandfather was an investor. Your father was an investor. You're an investor. Do you have a child who ultimately will succeed you?
I don't. I love my kids. They are the thing I'm most proud of in life. And but each one of them has chosen a different path. One in real estate. One is a litigating, working for the Attorney General, and one has started her own business and is an entrepreneur and is moving in that direction. I don't don't mind that patience to let the value of the business appear over time. I don't need it all at once. I don't need the big payoff.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 8 p.m. Eastern Time. Right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Let me ask you, what do you do outside the office? Are you a big art collector? Are you a big philanthropist? What do you do with your outside activities? And generally, if you're a value investor, you wouldn't probably be a big spender. That would be my impression, because value investors don't spend a lot of money on their personal habits. Warren Buffett doesn't seem to spend a lot of money on his personal habits, living in the same house he's lived in for 50 years or so. So are you a big spender on the outside of the money you make here, or do you basically live a very simple life?
Well, compared to my grandfather would say I'm a big spender because he once asked me to paint his oven rather than replace it. And my father's very frugal. I would say that, but none of us have ever felt deprived. Charlie Munger once said, deferring gratification gives him so much gratification that he's not sure he's actually deferring it. But both my father and grandfather were, at the end of the day, philanthropists. My father would talk about learn, earn, return. You spend a third of your life learning, a third earning, and then you move into this return phase. And both of them essentially gave away their entire fortune. They did not believers in inheritance.
Did you ever raise your hand and say, don't give it all away?
Yeah, my grandfather said, I don't want to deprive you of the dignity of earning a living. I said, you just deprive me a little bit. But I will say, I have sort of the same mindset, and each one has, my grandfather's passion was public policy, my father's was education, and for me, I creating parks is something I love. I think about that as, a very sort of democratic, with a small d, sort of mindset that, you create a park, and unlike building a building, the operating costs are very low. It becomes more valuable, and it's self-programming. People go there, and I think that connection.
Where do you do that?
So my biggest project is in the Hudson Valley Park in the Hudson Highlands, and I've worked with groups like Scenic Hudson.
So if somebody's watching this and says, I'm watching a famous value investor, and I want to get some tips about what I should do, should you go try to look for stocks yourself? Should you give money to a money manager? Should you give it to a long-only money manager, a hedge fund money manager? And what kind of rate of return should the average person watching a show like this try to get for his or her money? Is it 6% a year to be happy with, 7%, 5%, 8%? What do you think a value investing person should feel they should get as a rate of return on a consistent basis so they can go away, take a trip around the world, and not have to worry about their money?
An investor should recognize that the biggest threat to their generating a return over time is their own behavior. And so if somebody has the mindset of when stocks go up, I get excited and want to get in. When they go down, I want to get out. That behavior penalty will swamp any other choices they make in terms of whether they picked great stocks, whether they hired a great manager, whether they invested in a great fund. So what I would say is, if you are prone to these very normal behavioral biases, having a great financial advisor who can provide that sort of courage, that fortitude, and that patience, like the two lions at the public library, patience and fortitude, an advisor who can modify your behavior is is one of the most important investments you make. Now, if you're wired where you don't have that investor behavior problem, then that simple systematic investing, putting something away every month, every quarter, every year, those will matter so much more than whether you selected the hot manager or the right sector. You can get in at the wrong time, but if you stay in, you can earn your way out of that. What really matters is the behavior.
Why should somebody, a young professional, want to get into the value investing business? Is there a big future in that business? Is it more exciting than the other ones I've just mentioned? Why should some young professional want to be a value investor?
Well, they might be a masochist, but in a way, I think there's something, I would say the temperament of the young person is what's going to matter. In other words, do they have that patience? Are they thoughtful? This idea of being able to move in a very deliberate fashion, for me, it is incredibly suited to a research mindset. The other areas you mentioned, tech investing, it's exciting, it's dynamic, it's fast changing, and that suits a very different temperament. You think about the idea that being right more than you're wrong. Well, for a value investor, we think along those terms. But technically, what really matters is not how often you're right and how often you're wrong. It's how much you make when you're right. So I don't mind that patience, that sort of sort of traditional mindset that says I'm willing to let the value of the business appear over time. I don't need it all at once. I don't need the big payoff.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi in Beirut, and this is Bloomberg. Good morning. I'm Jemana Bersachi in Dubai, and here's what we're following this morning. President Trump says there's been a lot of progress in talks with Ukraine on a deal to end Russia's invasion. He hosted Volodymyr Zelensky at his Mar-a-Lago resort in Florida on Sunday. Zelensky says he asked Trump to consider providing his country with security guarantees that would last 30 to 50 years.
We discussed all the aspects of the peace framework, which includes, and we have great achievements, 20-point peace plan, 90% agreed, and U.S.-Ukraine security guarantees, 100% agreed. U.S.-Europe-Ukraine security guarantees, almost agreed. Military dimension, 100% agreed. Prosperity plan being finalized.
Former EU official Thierry Breton says the bloc must resist U.S. attempts to influence its legislation aimed at regulating social media platforms. Breton was speaking on French television after he was sanctioned with a travel ban last week by the Trump administration. He was the EU commissioner in charge of enforcing the Digital Services Act, which regulates content moderation on social media platforms. Digital Bridge shares have surged in pre-market trading on news that SoftBank is in advanced talks to acquire the private equity firm that invests in assets such as data centers. Bloomberg understands that a final agreement is yet to be reached, and details, including the timing, could still change. And a check on markets, and what we're seeing is sideways trading as liquidity is thin in this post-holiday phase. Stock 600 trading flat on the session. S&P futures down 0.2%. Silver plunging today, down 6%, and then Brent up, actually surging 1.7%, even though it is down on the month, 61.70. And this is Bloomberg.
Throughout our 31-year history, we've been very focused on shorting individual stocks that we believe will underperform the market and add value through that underperformance. That ability to have a fresh perspective, take in the new information, even when things aren't going the way that you'd expect or to hope. AI is going to impact virtually every industry we can think of.
Lee Ainsley's path to the hedge fund world was anything but conventional. With no early ties to finance, he set his sights on business and applied to Stanford.
Luckily, they said, Lee, we don't share your interest in our attending Stanford Business School. So I owe a great debt of gratitude to the Director of Admissions of Stanford.
That rejection led Ainsley to the University of North Carolina, where he crossed paths with legendary investor Julian Robertson, founder of Tiger Management and one of the pioneers of the hedge fund industry. Ainsley was among the first Tiger Cubs, joining the firm as a technology analyst. It wasn't long before he decided to forge his own path.
It was a Friday. He said I was crazy. It was a subtle way to put it. Had some other adjectives involved, and I came back Monday morning and told him my mind had not changed.
In 1993, at just 28 years old, Ainsley founded Maverick Capital with backing from the Wiley family and a belief in deep fundamental research.
We're simply trying to understand the dynamics behind different stocks, identify those that we think are long-term winners and long-term losers.
Today, Maverick manages more than $10 billion across both public and private investments. And while the hedge fund world has evolved significantly over the years, Ainsley's disciplined approach has remained constant.
That ability to have a fresh perspective, even when things aren't going the way that you'd expect or to hope, really a critical part of the business.
Ainsley has embraced innovation, including AI, but still sees steady leadership and deep moats as the key to enduring success.
I've always felt good management teams deliver good surprises and bad management teams deliver bad surprises.
From Tiger Cub to Maverick founder, Ainsley has built a firm and a legacy grounded in research, discipline, and having a long-term view.
First of all, I'm a very competitive person, and I see the scoreboard every hour. And it's one of the few jobs where you know exactly how you and your team is doing. Secondly, it's one of the few jobs where I get to learn every day.
So when people think of hedge funds, they often think of very complicated algorithms and people trading every hour on the hour, every minute on the minute. You have built a hedge fund that's very successful, but it tends to hold on to stocks for very, very long periods of time, which is different than some of your peers. So can you explain your investment philosophy?
Well, the term hedge funds has obviously come to represent a wide range of different strategies, many ways to skin a cat. And you're correct, many use a lot of exotic instruments, many are very trading oriented. By contrast, we've always thought of ourselves as investors. We're simply trying to understand the dynamics behind different stocks, identify those that we think are long-term winners and long-term losers, and then hopefully recognize discrepancies between our views and the views of the market, and to take advantage of those. And so to do that requires a great deal of intensive fundamental research, which doesn't really lend itself to a lot of turnover, a lot of trading, but we really want to get to know our companies quite well. And to your point, we typically are pretty long-term holders.
When you buy a stock, you typically hold it for 3 years or so, something like that?
Well, the average ends up being a little over 1 year. If you look at one of our largest positions today, we've owned it for 8 years. And indeed, we first bought it in 2000 and have owned it for the majority of the time since 2000. So Our core holdings end up typically being multi-year holdings, but there are a lot of shorter-term investments as well. Sometimes because you recognize you made a mistake, sometimes because others see some of the qualities that you're excited about in the stock in the first place, and so that difference in what you view as the value, what the market views as the value, has shrunk to the point you think there are more attractive opportunities elsewhere.
But you also short stocks as well, which is more complicated than buying long, I think. But tell me why you short stocks. Does that make it more difficult to talk to CEOs when you're shorting their companies?
So in our core hedge funds, we try to maintain a balance of long and short investments. For our hedge fund, shorting is a really important part of that strategy. It can be more challenging for a few reasons. You're absolutely correct. Management teams are a little less excited to talk to you if they think you're shorting their stock. Unlimited losses versus the long side, the worst I can do is to lose 100%. On the short side, you can lose a multiple of your investment. You're never writing your winners. On the long side, I'm right. That position becomes larger. On the short side is when I'm wrong, that the position becomes larger. So, and I can go on. So there are a lot of challenges shorting stocks, and I think that's one of the aspects of Maverick that has distinguished us from many of our peers is throughout our 31-year history, we've been very focused on shorting individual stocks that we believe will underperform the market and add value through that underperformance. And as a result of maintaining that balance, we really have not had a lot of correlation to the markets over time.
Now, as we talk, the big, beautiful bill has passed Congress and the president signed it. Does that affect you one way or the other? Do you really care about things in the big, beautiful bill? Or really you're not a macro kind of investor, so inflation rate, interest rates, the value of the dollar is not a big deal to you. Is that fair or not?
It's certainly fair for the large majority of the time, again, by being hedged and thinking about our factor biases, et cetera. Hopefully, we're not really influenced in a significant way by those macro variables. Having said that, there are periods of time where those macro variables are extraordinarily important to the stock market and to individual stocks. The financial crisis, inflation and rapid rise in rates in 22, discussion of tariffs. I think it'd be really hard to invest and just have your head in the sand and not understand the ramifications of that.
Do you mostly invest in the United States, or do you actually invest a lot outside as well?
We've been international investors from day one. Indeed, if you look at this year, emerging markets has been the biggest driver of our returns.
So as you look at the U.S. economy today, we're not in a recession, unemployment's low, inflation's coming down. Do you have a big worry about the U.S. economy?
Certainly worry. I wouldn't say I think it's likely. There are two individuals, Ben Silver and David Tikhonczynski, who have been in charge of running the public funds for over 4 years now. They are a little less concerned than I am about the impact of tariffs. I still have in the back of my mind that we could see the double whammy of both a slowdown in growth with some inflationary impacts as well, but we'll have to see how that plays out.
So when you're looking at a company that you want to buy and the staff comes in and recommends it and so forth, what are the key things you're looking for? A good CEO, a kind of moat around it so there's not a lot of competition, let's say, that can overcome the company. What are the things you most look for in a company you're going to buy long on?
So at our 30th annual meeting a couple years ago, and at the annual meeting, we showed some of our very original presentation we put together back in 1994. While we've worked really hard year in and year out to improve our abilities, what we're looking for in different investments, our investment strategy has been very consistent throughout. Yes, moats. We're trying to think about different secular trends that should persist, competitive dynamics among different companies, the quality of management teams, and I think this is one area we probably put much more emphasis on than many. I've always felt good management teams deliver good surprises and bad management teams deliver bad surprises. And that's endured. Looking for those characteristics has served us well for a long time.
So the hardest thing in the investment world, I often think, is admitting a mistake. At what point do you say, we made a mistake and we're getting out? How long do you give it before you say, this isn't working?
I really think that's one of the most critical differentiators between great investors and just mediocre investors. Because on one hand, you have to have confidence and conviction in all the work you've done, the decision you've made, that if you have a little stumble here and there, if you immediately are selling out, you're never really going to fully realize the depth of potential long-term success. And yet, on the other hand, if you're stubborn and you refuse to admit I'm wrong, if you continue to think the market's wrong and I'm always right, then you'll get caught in some very, very difficult positions over time. So that ability to have a fresh perspective, take in the new information, even when things aren't going the way that you'd expect or to hope, and to really understand from this price point today, is this still going to be one of the most compelling investments or not? Much easier said than done, but really a critical part of the business.
So the hedge fund world, since you first joined it with the Julian Robertson and since you started Maverick, how has it really changed?
When I first was at Tiger, having a 2-martini lunch was a pretty common experience for the older crowd. 10 Qs showed up in the mail. So it was a much less competitive, slower period for the investing world. Starting a hedge fund today, I would argue, is much easier because back in '93 when we started, there were a lot of things we basically had to build from scratch. So people just did not have these systems. And the fact I had a background in technology and engineering was very helpful. Today, the drop of the hat, a prime broker can, boom, put on your desktop sophisticated risk management systems, all the trading systems you need, et cetera, et cetera, et cetera. Having said all that, I would argue being successful today is much more challenging because the world is far more competitive.
So artificial intelligence has come along and everybody's excited about it, though people 5 years ago barely knew what it was. Is there something you think might succeed artificial intelligence as the next best thing that people are going to be excited about in the investment world, or something else in the technology world in the next 5 years or so?
The day the iPhone was introduced, Nokia and Apple both had market caps of $80 billion. 5 years later, Apple was $400 billion, Nokia was $20 billion. So 20-fold difference. That's just one small example of the impact innovation can have. AI is going to impact virtually every industry we can think of. So when I think of the next steps, they actually, in my mind, will be AI driven. I think robotics will be a very real, very pervasive part of our lives. Something with that self-driving cars or something doing your laundry. A lot of this is going to require energy in abundance that is virtually free, but I think the rate of change is accelerating and that it's almost hard to imagine where we're going to be in 10 or 20 years. It was a Friday. He said I was crazy, had some other adjectives involved, and asked me to consider it over the weekend, and I came back Monday morning and told him my mind had not changed.
Technology is embedded in every aspect of our lives and laying the foundation for the future. From finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Annabelle Drulers in Hong Kong. I'm Sherrianne in Tokyo. Watch Bloomberg Tech Asia, only on Bloomberg Television.
The multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Let's talk about your own background and then how you came to start Maverick. So where were you born?
Born in Alexandria, Virginia, outside of D.C.
What did your parents do?
My father was a teacher and eventually was the head of 2 different schools, and my mother was an accountant.
So you went to college in Virginia?
I did.
At the University of Virginia?
Correct.
And then what did you do after you graduated?
I was an engineering student, undergrad, and I went on to be a consultant on the technology side right after college.
And then you decided to go to business school?
I did.
And you applied to Stanford Business School?
I did.
And what did they say?
Luckily, they said, Lee, we don't share your interest in our attending Stanford Business School. And I say luckily because as a result, I went to the University of North Carolina for business school. There I was asked to work with the board on a couple different things. And there was a board member named Julian Robertson who ran the Tiger Fund. At that point in time, Tiger had not really hired business school students. I had developed an interest in stocks when I was in 8th grade, and it was still my hobby at that point in time. So Julian and I spent a lot of time talking about stocks. And for me, it was like talking about basketball, Michael Jordan. I just thought this was so amazing, but it never really crossed my mind it could be a job opportunity. As a matter of fact, I'd accepted a job to go work at Goldman Sachs, and about 2 weeks after that, I got a phone call from Julian asking if I would consider working there, which I ended up doing. And to me, that was one of the great breaks in my life, so I owe a great debt of gratitude to the Director of Admissions of Stanford.
So you went to work for Julian Robertson, who was one of the leading hedge fund people at the time when there weren't that many hedge funds. So what did you specialize in there?
Well, the first few months I was a generalist and spent a lot of time on consumer and retail, but after a few months they asked me to lead the technology investing efforts. And so the rest of my career there I was focused on tech.
And did you have mentors there to help you?
There's a guy named Steve Mandel, who's still a very good friend. He joined Tiger just a couple months before I did, but I was coming right out of business school, and he had already been in Goldman for 8 years, and he took me under his wing, and it was really, I got that promotion to take over the technology sector rather quickly, which is really on the advice of Steve to join. So Steve's another person I know a great deal to.
So after 3 years there, and you're doing well, presumably. Julian likes you. Steve Mandel's mentoring you. You go to Julian and say, you know what? I'm going to start my own hedge fund. What prompted you to leave after those 3 years?
It was a Friday. He said I was crazy. It was a subtle way to put it. Had some other adjectives involved, and asked me to consider it over the weekend. And I came back Monday morning and told him my mind had not changed. And that was a really tough conversation because Julian had been incredibly generous, kind, gave me this great opportunity. But I really, and in hindsight, I was a little naive and probably a little arrogant, and I had probably a little more confidence than I should have in my ability to succeed. But thanks to a family called the Wiley family, Sam and Charles Wiley, they were willing to back me and gave me an opportunity to start something on my own.
So at Maverick today, are you responsible for every investment decision? Do you have to approve every single investment decision that's made?
So I gave up day-to-day responsibility on the public side about 13 years ago, and for the last 4+ years, Ben Silver and David Tikczynski have had those responsibilities, and they've done an amazing job. On the private side, early stage investments have been led by David Singer for the last 20 years, and Maverick Ventures is our second important business. And then the third business today is Maverick Silicon, which is a fund that will focus on late stage, or is focusing on late stage private companies, trying to address the insatiable demand for compute and AI infrastructure, and that's led by Andrew Homan. So those are the individuals making all the day-to-day investment decisions.
So today, your job is to oversee your professionals, but once a week, do you review the portfolio and say, this is good, this is not good, or how do you oversee this?
We have in-depth discussions. We officially meet every 2 weeks on the public side, and I'm not shy to weigh in and give advice when I think there's something that we may want to think about twice. But again, I have great confidence and respect for those individuals and don't really want to be over their shoulder nitpicking day in and day out.
Parents are often concerned these days that their child won't get a job at a place like Maverick or Google or Goldman if they don't major in a STEM subject, science, technology, engineering, or math. Do you have a view that it makes a difference what you major in before you hire somebody?
I think 5 years ago, or 3 years ago, I would have said STEM is something you really need to give serious consideration to. I think AI is changing that. And a lot of the disciplines that are very helpful from a STEM background, AI is probably already doing quite effectively. As, again, a son of an educator and been involved in a lot of different schools, I've been very proactive in working with these schools, making sure they're not fighting AI. Don't make AI illegal. You're not allowed to use it. On the contrary, teach them how to use it. Embrace AI, because the folks coming out of college now and over the next several years, if AI is not a tool that they're very comfortable with, and they're not able to add value in other ways, they're going to have a tough career. So I think the world's changing quickly in this regard as we speak.
I think we'll be at the point at some point in the future where AI itself will make the investment decisions for hedge funds like yours, where you won't need as many people, you just rely on some kind of AI, or you don't think we're going to get there anytime soon?
So again, hedge funds means a lot of things. So I think it depends on the strategy a bit. And one of the reasons we've always been very equity focused, whether it's private or public, is obviously that's the very end of the value stack of the enterprise value. So little changes in enterprise value can be big changes in equity. And B, companies run by people. And so understanding people, their motivations, their integrity, the quality of their decisions, et cetera, is such a valuable skill, and I would argue that is going to be the last frontier where humans will still do a demonstrably better job. Back to your question, I hope that's true for 10, 20, 30 years, but I don't think it'll be true forever. I'm a very competitive person, and it's one of the few jobs where you know exactly how you and your team is doing. I get to learn every day.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
What are you looking for in young talent that comes out of business schools or has been already at another hedge fund?
I'd say a few things, and some of these are probably a bit obvious, but a sense of dedication, competitiveness, obviously you need to be rather bright. Emotional consistency, we call it. So the highs aren't that high and the lows aren't that low. For us, a team orientation and interpersonal skills are really important. And so Maverick has a much stronger team culture than I think many hedge funds. And we succeed or we don't succeed as a team, and we're not really as focused as on an individual's contributions. In the investment business, if you're right, meaning I've picked a long that outperforms the market or a short that underperforms the market, 55% of the time, you're now one of the best in history. That's as good as you can do, which by definition means you're wrong 45% of the time, even if you're really good.
So suppose somebody comes to you and says, I like working at Maverick, it's very nice, but I want to start my own hedge fund, not unlike what you did. Do you throw them out the door right away, or you tell them not to do this, or it's not that easy to do, or what happens?
Well, we have always encouraged folks to be very open with us, whether they're thinking about starting their own fund or going to a competitor or whatever it may be, just because, A, the earlier they tell us, the more we can prepare for potential departure. But more importantly, it really gives us the opportunity to give them some hopefully valuable feedback. I've had discussions where people have laid out an opportunity, and I stand up and hug them and congratulate them. I'm excited for them. I've had discussions where I've said, oh gosh, you don't really understand what you're yourself into here. Let me walk through. If someone does want to potentially start a fund, I certainly understand that. I went through that myself. And we'll try to be supportive. I root for my quote-unquote competitors. And certainly someone that's leaving Maverick, I'm going to do everything I can to help them be successful.
So if somebody asks you, what is the most common mistake that average investors make, what would you say that is?
The world has become, and I think this is really true on the professional investment side, in the world of pod model multi-strats, most of those investors have very, very short time horizons, and they're very worried about my performance today and this week, which makes it really difficult to take a step back and think about where is the world going to be in 5 or 10 years, and how is this stock going to fit into that? And then secondly, you mentioned this a bit earlier, just underestimating how important management teams are. You can have a great stock with great fundamentals, great competitive advantages, a deep moat, et cetera, et cetera, et cetera. But you put in a poor CEO who makes bad decisions regarding capital allocations, regarding how he promotes, manages others, et cetera, et cetera, et cetera, that you may have a very bad investment in your hands, even though the fundamentals were in your favor.
What is the best investment advice anybody ever gave to you?
I'd say two things. Sorry to be repetitive, but the importance of management. That was something that Julian really harped on. But secondly, just the importance of integrity. So when you're building relationships with the people I work with brokers on Wall Street, certainly with management teams, perhaps most importantly with our investors, if you're not constantly conducting yourself, and that's not true for me, but every member of our firm, with the utmost integrity and thinking about the ethics of every decision you're making, That doesn't really work in the investment business. Your career will be a short one.
So if somebody said to you, I got $1 million, I'm 30 years old, I don't really have to have current yield, I'm happy to take some capital appreciation risk, what would you recommend somebody do with $1 million or with $100,000?
I think on the longer term basis, you certainly want equity exposure. I personally think, a little bit like we were talking about earlier with hedge funds, likewise, active management on the long-only side, there are a number of active managers that can do quite well and I think outperform the market over time. Majority do not. Therefore, if I'm investing a smaller amount of money, I'm probably looking at index fund. And I think a lot of it has to do with your risk tolerance, your age, your future needs of that capital, to what degree it's in a more conservative fixed income strategy versus equities.
What's the future of Maverick? Do you intend to run it as you are now for the next 10 years, 20 years? You're going to expand it?
Well, I'm certainly hoping my role for at least 10 years. We'll see if I make it 20. I'm very fortunate that we covered some of this earlier, but 3 different business units, each of which are led by very capable individuals. And so they'll be in place for a very long time. I love what I do. I'm very engaged. I stink at golf. So I don't really know what else I would do. So I plan on being in the seat for quite a while. This will sound corny, but collecting fond memories with family and friends is probably what I focus on more than anything else.
What is the excitement that gets you out of the bed every morning to be a hedge fund investor?
I'd say 3 things. First of all, I'm a very competitive person, and I see the scoreboard every hour. And it's one of the few jobs where you know exactly how you and your team is doing. I get to learn every day about companies, industries, macro influences. I'm very fortunate to work with these really talented, nice people that I find stimulating and fun to be with.
On Bloomberg Open Interest.
Politics will drive the economy. Now the conversation is AI is driving the economy.
AI story and really the economy and inflation story will probably be front and center.
We saw the promise of like ChatGPT. 35 million people are paying for it.
We have the ChatGPT versus the Google platform. Maybe there's pressure on the rest of the secondary and tertiary players in the market.
Don't miss Open Interest live every weekday.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets. Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
Good morning. I'm Joanna Versace in Dubai, and here's what we're following this morning. President Trump says there's been a lot of progress in talks with Ukraine on a deal to end Russia's invasion. He hosted Volodymyr Zelensky at his Mar-a-Lago resort in Florida on Sunday. Zelensky says he asked Trump to consider providing his country with security guarantees that would last 30 to 50 years.
We discussed all the aspects of the peace framework, which includes, and we have great achievements, 20-point peace plan, 90% agreed, and U.S.-Ukraine security guarantees, 100% agreed. U.S.-Europe-Ukraine security guarantees, almost agreed. Military dimension, 100% agreed. Prosperity plan being finalized.
The U.S. president will meet the Israeli prime minister in Palm Beach, Florida later today. Tensions between them have been rising, with Trump previously warning Israel not to undermine his peace efforts. They're expected to discuss the second phase of the Gaza peace plan, as well as Iran. Digital bridge shares have surged in pre-market trading on news that SoftBank is in advanced talks to acquire the private equity firm that invests in assets such as data centers. Bloomberg understands that a final agreement is yet to be reached, and including the timing could still change. China has pledged to expand government spending and improve how it deploys capital in a bid to boost growth in 2026. The government will focus on better targeted fiscal policies, spending more on advanced manufacturing and tech innovation. It highlights the fine line Beijing is walking between buffering the economy against external headwinds and preventing a domestic debt crisis. Major storms on both U.S. coasts are disrupting travel during the busy post-holiday period. Airports in New York, Detroit, Philadelphia, and Boston have been hit with heavy snowfall, with more than 1,600 flights canceled across the country. In California, heavy rain, mudslides, and flooding have led to road closures, while the Great Lakes region is facing hazardous travel conditions due to accumulating ice. And a check on how some of these key indices are trading in these post-holiday thin liquidity over here. But Stock 600, you can see, down 10 basis points, so marginally in the red. NASDAQ also leaning towards a weaker open today, down 0.4%. Silver at one point hitting $84 per ounce in the session, now plunging down 4.5%, still up 30% in the last month. And then Brent up 2% today in trading on that positive news out of China. Let's switch over and take a look at defense stocks, one of the key outperforming sectors this year in Europe. Not a pretty day today. Leonardo down 4.2%. Other names in the space as well, down anything from 2 to 3% as well. So some profit taking probably taking place before the end of the year. And that was your recap. This is Bloomberg.
We're a dedicated active management firm and don't believe that you can't beat benchmarks or that you can't outperform the passive funds. You've got to understand and anticipate your clients' needs and how they're changing. Have a plan and be disciplined. Don't cut your flowers and water your weeds.
When Robert Sharps was growing up in Western Maryland, his interest